There are two tectonic shifts going on in the investment world that no one is talking about, or they're getting so underreported. And I know this because I see it show up in the comments on this YouTube channel, and I see it show up with what people are telling me they are worried about. I want to talk about those two tectonic shifts, what you can do about it to make sure that you're not left behind and you're not hurt, even if you're not going to do anything with that specific investment. Stick around. We're going to get into it. It's going to be good stuff. Hey guys, this is RC Peck with Fearless Wealth, and I want to talk to you about two things going on today. And it's really kind of one thing or it's kind of in this bowl of the same problem. So the first thing is I want to talk to you about China versus crypto. This is a huge story that is getting really not a lot of news coverage. And even the China just in general is really not getting a lot of news coverage. So I want to talk to you first about China versus crypto. And then I want to talk to you about the US versus the world. I got a comment, and let me just read the comment to you. I got this from David Hong, and David, I will respond to you. Did I just waste my time watching a video telling me what to do in the future? Go all in US stocks based on a 1-year price chart of emerging market stocks? This is sad. Save your money and go read a book from investing legend John Bogle, founder of Vanguard Group, and get some real insight into asset allocation. You may end up deciding all US stocks, but it should never be based off 1-year returns. So, David, first of all, thank you for using your real name because I appreciate that. And I'm going to respond to your comment. I love comments, guys. Please tell me where you think I'm right and where you're wrong. I'm going to jump into that as my second point and really talk to you about how you can think better and be a better thinker and investor with investing. Okay, with that, let me first talk about China versus crypto, and then, David, we're going to have a talk here. So let's pop over to, this is actually a price chart of the S&P. So let's talk about Bitcoin first. Bitcoin, crypto, China. So on September 24th, China came out and said, we are banning all crypto. Now they were moving into this already, right? So it wasn't necessarily a surprise. Prior to that, they stopped 95% of all mining in their country. Now, that might be an electricity issue because China's having a lot of problems with their electrical grid. They're not producing enough electricity for their country, and that is an embarrassment to them. I was an Asian studies major. I spent a lot of time in Southeast Asia and China in the 1990s and in my 20s. I can tell you this whole save face thing for Chinese on a world stage is really important. So they are pretty embarrassed that that they don't have enough electricity. So maybe one of the things they said was no more crypto mining. It takes too much electricity. I think that's a secondary or tertiary thing to what's really going on, and that is China wants to be a world currency. And they want the yuan to be a digital currency. So they've outlawed all digital currencies. Now, if you look at the screen here, this is, I actually didn't count them out. Let me just quickly check. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So here's 12 digital currencies. We could actually get rid of, what is this one? The US dollar one, because it doesn't matter. So here's 11 digital currencies. This is the price of them after September 24th. Now, you can look at the screen. It doesn't matter. I'll tell you which one's gone up the most. But what you can see here is crypto is bigger than China. Cryptocurrencies is bigger than China. China is the second largest economy on the planet from an individual company, right? Or an individual country or an individual state. But crypto is bigger than China because crypto said, yeah, whatever, China, we actually don't need you. Now, China wants to have their own cryptocurrency, and it's going to be the digital yuan. They are lending out trillions of dollars all over the planet, and they're going to have those people pay them back in digital yuan. So they are spreading their digital yuan all over the planet. It's going to be one of the major cryptocurrencies. It's just not going to be any on this screen. So that is why China outlawed. But that is a really big piece of information that crypto is bigger than China. Even though Xi Jinping, did you know he can't lose office? Laws were changed in 2018 in China that he no longer can only stay on for 2 terms. So it's a true dictatorship. But one thing we do know is when inequality in wealth or income gets too wide, whether it's a dictatorship or whether it's a capitalistic, it doesn't matter. There's going to be a lot of issues. None of those Chinese Communist Party people were elected. They were all put in place. So I think China's a little worried what's going on. That's why they have attacked the gaming industry, the online education industry, a lot of the digital industries, a lot of the internet industries, and they are paying a huge price. The market cap of Chinese stocks today is only about 7.5 trillion. 7.5 trillion. Not that big. Ish, US is about 75 trillion. So an order of magnitude, right? I mean, think about it. You could add up Apple, Microsoft, Google. Do we need, I guess, throw Facebook in too? And you basically have the Chinese economy. They're not allowing creativity. But I think this price chart, if you look at the screen here, this price chart is really important. Crypto is bigger than China. What crypto is up the most, at least the 11 I'm looking at here, Bitcoin's up 29% since China said crypto is banned. Stellar is up 27%. Stellar is about an $8 billion market cap company, so keep an eye on Stellar. Its symbol is XLM. So that's crypto there. I think one of the best ways you can play crypto is one of 2 things. Either buy and hold, okay, do a buy and rebalance, or trade it. Really, those are your only ones. When trading, you want to have a really clear signal. Anyway, so that is the first story. The big thing I really want you to hear the most from this is the following. I'm using my eyes. I'm looking at a price chart. I'm taking a date or a piece of information, September 24th, China bans all crypto, and I'm looking at actual price. I'm not listening to someone's opinion. You guys don't need to listen to my opinion. There's enough opinion people out there. What I'm doing is I'm looking at price chart. And that's what I want David to know too. David, I love that you spent the time and replied to me. Thank you so much for that. And we're going to get to what you brought up in a moment. But what I want you to know most is you have to learn how to think with your eyes, not your ears. That means learning how to read price charts, learning what the signals are that you are right or wrong, and learning where the strength is or isn't, or where it's flowing or where it's leaving from. That's it. 3 things, and you can do them all visually. Okay, David, you're awesome. I totally appreciate you, bro. I love that you made a comment to me. Let's talk about what's going on. So I have 3 things on the screen here, guys. Let's see how we're doing. I have 3 things on the screen. This video is going to run a little long, but this is really important. First of all, I don't care if the S&P 500 or the US stock market is the leader in the future. I'm not attached to what the geographic leader is, whether it's Europe or emerging markets or the US. I don't care. I just want to have the right one, and I do not want to diversify. So I want to be really clear to all the Bogleheads out there that I think diversification is an absolute tax on you not willing to update your beliefs about investing. It's okay to buy the S&P 500. There's 504 stocks-ish in there. That's fine. But owning the S&P and emerging markets and international and Europe is absolutely going to slow down the growth of your money. Now, if you look at the screen here, this is actually 15 years of data. The blue line is the S&P. The red line is emerging markets, and Europe is the green. So we're going to go in reverse order. So the 15-year return, you want to be in US stocks for the last 15 years, okay? It's super duper clear. We have the global financial crisis in there. We've got COVID in there. We've got all this crap in there. It's 15 years. It's a decade and a half. You would have wanted to be in the S&P 500. Okay, let's go to 10 years. Let's go back to 10 years. And let me just get back to 10 years. We're going to get pretty close. Okay, let's get back within a day or two. So here's 10 years. This is the 10-year return. Over the last 10 years, you would have wanted to be in the US. Guys, I'm not waving a US flag. This is not anything against China or emerging markets or Europe. I'm simply talking about the size of your portfolio. Over the last 10 years, you would have wanted to be in the S&P 500. The green light on the screen, take a look at that. That's Europe. Second place, like a really, really, really far back second place. Okay, and then the red line is emerging market. Okay, so we got 15 years, we got 10 years. Let's go to 5 years now. This is 1250. This is 1250, about 1250 days. Let's get back to that. Let me get close to it. And it's right about here. This is the last 5 years. We've got 15 years, we've got 10 years, now we have 5 years. The blue line is the S&P 500 on the screen. You can see that. The green line is Europe, the red line is emerging markets. That's the last 5 years. Let's go the last 3 years. Let's squeeze. Let me get this guy. Come on, baby. Let's just go to about 760 days. Let's see how, oh, I'm actually pretty close on that. So here is the last 3 years. The last 3 years, S&P, and look at that, Europe and emerging markets are basically tied. But I don't know if you've been noticing the difference. It's been a marked difference. Over the last 3 years, the S&P's up 60% and Europe's up 30, emerging markets up 30. That's a big difference, right? $500,000 in the US, multiply it by 0.6, you get an extra 300 grand. Those other guys, you only get an extra 150,000. I got to tell you, I want the extra 300 grand, not the extra 150. And then lastly, let's do 250 days, which is 1 year. And this is the fairest way I know how to do it, because I'm going with 1 year, 3 years, 5 years, 10 years, 15 years. So I didn't pick those. That's kind of the standard of what people look at when they're looking at performance. And here we have the last 1 year. The US is the blue line, up 28%. Europe's pretty close over the last 1 year at 26%. And emerging markets is absolutely the loser. So emerging markets been the loser over all 5 periods. I don't want this to be a hit piece, but I want to be really clear here. I'm not attached to which part of the world is leading. I'm not attached to which sector is going to grow your money best. My attachment is more to portfolio. And I believe the only way that that can happen is to understand how to read price charts, because they don't lie. Price takes all the information in the world, digests it, and puts it on a chart. You have to learn how to read that. You have to learn what the signals are, right, when you're right or wrong, and where the strength is, where it's increasing, where it's decreasing. Guys, let me know where I'm right. Let me know where I'm wrong. I'm here to learn. I'm a lifetime learner. If you like this video, if you like these videos, please hit the like button. Please leave a comment. What am I missing? What do you want me to talk about? What do you want me to cover? What's on your mind? Is it inflation? Is China really bothering you? Is the debt ceiling really bothering you? It shouldn't. And if you like this stuff, guys, you're going to love my free course, Clarity and Control, so you can check it out below. All right, guys, thanks so much, and I will see you on the next video. Bye.